What if the biggest shocks in financial history didn't arrive with flashing headlines or sudden crashes, but with a quiet decision made behind closed doors? What if a single institutional move, involving 800 million ounces, reshaped an entire market long before most participants realized anything had changed? We're told to watch prices, follow news cycles, and react to volatility, but this story challenges that playbook. Because when J.P. Morgan executed an about-face of historic scale, it wasn't responding to panic, it was responding to pressure that had been building for years. The mystery isn't whether this move mattered. The mystery is what broke beneath the surface to make it unavoidable. To understand why this about-face mattered, we need to understand who J.P. Morgan is within the global financial system. This is not just a bank. It is a primary dealer, a major derivatives counterparty, and a central pillar of modern market liquidity. Institutions like this don't merely participate in markets, they help hold them together. Modern markets themselves are built on leverage, futures contracts, and paper claims. Trillions of dollars in exposure trade daily, often detached from the physical assets they reference. As long as liquidity flows smoothly, this structure appears stable. But stability in such systems is conditional. It depends on confidence, access to supply, and the assumption that stress will always be manageable. For a long time, those assumptions held. Until they didn't. The origins of the 800 million ounce exposure trace back to an era of extraordinary confidence. Interest rates were low. Central banks provided liquidity at historic levels. Volatility was suppressed and risk models were built on years of relative calm. In that environment, large positions were not only acceptable, they were efficient. Concentration reduced friction. Rolling contracts forward became routine. Physical delivery risks were considered theoretical rather than imminent. Cause led to effect. Easy money enabled leverage. Leverage encouraged scale, and scale reinforced the belief that markets were under control. That belief would eventually be tested. As time passed, the exposure expanded. Each successful rollover increased confidence. Each quiet settlement reinforced the assumption that liquidity would always be there when needed. But growth came with a hidden cost. Dependency. The larger the position became, the harder it was to unwind without consequence. The system didn't just tolerate the exposure, it adapted around it. Pricing, liquidity, and expectations adjusted to its presence. The market grew calm, not because risk disappeared, but because it became concentrated. The breaking point arrived when physical constraints collided with financial promises. Supply tightened. Delivery pressure increased. Volatility, long suppressed, began to reappear. Suddenly, the difference between paper exposure and real-world availability mattered. This was the moment of the about-face. An 800 million ounce reversal is not speculation. It is a defensive maneuver. It signals that risk has shifted quietly but decisively from one side of the market to the other. J.P. Morgan didn't cause the earthquake. It felt the tremors first. The immediate aftermath wasn't dramatic. There were no instant collapses or obvious failures. Instead, the effects appeared gradually. Price behavior changed. Liquidity became uneven. Volatility surfaced in places it hadn't before. Smaller participants felt pressure without understanding its source. By the time the broader market noticed instability, the original move was already complete. This is how systemic shocks propagate. Absorbed by the largest institutions first, then dispersed across the system. Regulators and exchanges responded with familiar tools. Margin requirements adjusted. Risk frameworks were refined. Market rules were tweaked. But none of these addressed the core issue. A system built on paper claims far exceeding physical reality. History shows that such fixes don't eliminate risk, they postpone it. Each delay increases complexity and amplifies the eventual adjustment. The structure remains vulnerable, even when it appears calm. Today, the same patterns are visible across global markets. Derivatives exposure remains enormous. Concentration risk persists. Liquidity looks deep until stress reveals how thin it truly is. The cycle repeats. Leverage creates calm, calm invites risk, risk demands reversal. And when reversals happen at institutional scale, they don't just move prices, they redefine stability itself. So what does this market earthquake really teach us? First takeaway: when systemically important institutions change direction, it's not about prediction, it's about survival. Second takeaway: markets can appear stable for years while stress quietly accumulates beneath the surface. Third takeaway: The most important financial events often unfold silently, long before headlines catch up. The warning is clear: markets don't break because of surprises, they break because assumptions go unexamined. And the open-ended question remains: if an 800 million ounce about face was necessary to manage risk once, what hidden earthquakes are forming right now? If this analysis helped you see markets differently, support the channel by liking the video, subscribing for deeper financial breakdowns, and sharing your thoughts in the comments. Because understanding how these systems really work is the only way to recognize the next shock before it arrives.